Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, June 5th, 2021. And our top story today, congressional proposals cause concerns for the Federal Retirement Thrift Investment Board. And joining me now to discuss this and a lot more is Kim Weaver. She's Director of External Affairs for the Federal Retirement Thrift Investment Board. Kim, so great to see you. Thanks so much for joining us on the program this morning.
Thank you for having me.
Yeah, and you know, just for information purposes for the audience, the Federal Thrift Savings Plan is not only is it the largest defined contribution plan, I believe, in the world, but this serves all of our men and women who are working for the federal government, including, I believe, active military. Is that correct?
It is. We have 6.2 million participants, and that includes federal employees, postal employees, members of the uniformed services, the judicial branch. We cover the gamut.
Yeah, absolutely. So, and I mean, it's just an amazing plan, really a streamlined plan, and I would argue probably a pattern or a template that a lot of other plans, both here in the U.S. and abroad, should certainly look at and try to imitate or follow. Kim, a couple things I wanted to ask you about. One, congratulations on all the success. Two, there have been some proposals around kind of curtailing some of the investments. I'm not going to mention the proposals by name. You certainly can. But certain senators, as well as the White House, have been looking at maybe putting in some restrictions or curtailing some of the types of investments or allowing certain types of investments. I want to get your response on this and your thoughts as an agency.
So I think the most important thing to know about the Federal Retirement Thrift Investment Board is we're run by 5 board members and an executive director. All of them are fiduciaries, which I'm sure your audience is well aware of, right? So we serve solely in the interests of our participants. And I think the word solely is really important here because that's what we have to put above all. And so that's the standard by which we judge proposals that come out about the TSP. Is it solely in the interests of the participants? And as you've mentioned, there have been some proposals that have been put forward that would limit the ability of the TSP to invest in emerging markets, mostly because it would, emerging markets by definition includes China. And there's legitimate concerns about China and its friendliness or lack thereof to the United States. Our view is if it is legal for any other American to invest in an emerging markets mutual fund, for example, that includes China, then there shouldn't be any restrictions on the TSP. And one of the proposals that was made that had a sort of slight twist that was new, we are getting ready to move to a new record keeper next summer. We're in the process of that transition right now. And the new record keeper will be able to offer a mutual fund window to our participants, which is something we're very excited about. It will allow our participants to take a portion of their account and invest in more than 5,000 mutual funds that'll be on the platform. But one of the proposals would say that none of those mutual funds could have any equity based in China. And as you know, you and your audience are aware, trying to keep track of what a single equity that any mutual fund runner may have, it would be impossible. It would be practically impossible and unaffordable for us or our record keeper. And so we just wouldn't offer it, is the likely outcome of that conversation. And it would be a real shame to lose that opportunity for our participants.
Yeah, and I think, you know, I have, as a reformed record keeper back in my day when I was a record keeper, I lived through some of the day trading that was happening, if you recall, with some of the funds, the foreign funds, overnight, and trying to put in some safeguards there to make sure that people were not arbitraging, and they were aware of what happened, for example, in China or like the Nikkei index, and then would trade in their plan up to 4 p.m. because that was the deadline. That was really difficult. I can only imagine, and you're talking about this, the challenges not only of doing this at the participant level, but also at the individual fund level, because after all the investments in the federal thrift are all, to my knowledge, indexed. And
They
so
are.
there'd be a lot of scrutiny, and I mean, you'd have to have scores and scores of systems and people to do this type of work.
Yeah, it would. I mean, in terms of our fund, as you mentioned earlier, we have a very streamlined fund. We offer 5 core funds: the S&P RC fund, the Dow Jones Completion for our S fund. Our international fund is the MSCI EFA, so it's only developed. Our F fund is the Barclays, and then the G fund is specially issued treasuries. So those index funds, with the exception of the I fund, they would not be implicated in any of the legislation that has been put forward. But the mutual fund window, to the point you just made, is a whole different kettle of fish, and it would be cost prohibitive to do anything to try and monitor down to the equity level.
Now, as I mentioned, these elected officials, and by the way, as for the audience's edification, they have some oversight here. So it's not like they just are just saying, "Hey, we want to be involved." They do have an oversight role here. Changes that happen, whether it's allowing active military or other plan design changes, I believe have to go through the members of Congress to be approved and ratified, et cetera. So there is a role to play for Congress, but from an executive point of view, obviously very challenging. And this is an example, I'm just going to give my opinion. This can be an example where policy makes a lot of sense, but putting the practicalities of the policy can be challenging.
I think that's exactly right. And absolutely, Congress has a role. I mean, we are essentially the record keeper for the federal government as an employer. And Congress is the sponsor, if you want to frame it in that sort of context. And so it is clearly Congress's role to oversee the board and the TSP to make sure we're carrying out our duties as we're supposed to. And we would never in a million years, question that. What we do question, obviously, is sort of, as you said, how the fiduciary role and the mission of the agency comes up against a policy that's suggested. And we feel it's our duty to make sure that people realize where the rubs come.
Yeah. And Kim, you had mentioned, I guess, last question, you had mentioned that there might be a transition to a new record keeper, or there will be a new transition to a new record keeper. Has that timeline been finalized, or is that still, I've been through a lot of transitions. I can only imagine, and I thought those were big plans, 20 billion, 25 billion. I can only imagine the nuts and bolts that go into transitioning a plan from the existing record keeping, which is done by in-house staff and will be transitioned to a new company. What does that timeline look like?
We are planning to go live in the summer of 2022. And so the contract was awarded in November. We have been, as you might imagine, diligently working with the new record keeper to make sure that we've got a plan, that we have scoped everything out, and then it's a matter of just chunking away at the plan and not letting anything fall through the cracks. And there are an enormous number of details that have to be worked out.
Yeah. Not only, just for the audience, it's not only the funds that have to move over, it's the participant records, each individual participant.
In our case, it's only the participant records. The fund, BlackRock and State Street will continue to manage the funds. The record keeper, the new record keeper will will be responsible for record keeping the 6.2 million participants. So there's enough complexity with that. We don't have to, the fund transfer would be, that little extra on top of it, but thankfully that's not part of this.
Yeah, and thanks for correcting me on that. I was just trying to explain that in a typical transition, you might move funds, you might re-register them, but you've got all these different components, not only the participant records, but their asset allocation, where they want their monies, their future contributions to go. The plan design, although it's the same for everybody, getting that all up and running. So there's a lot of I's to dot and T's to cross. Well, Kim, we're going to have to leave it there. Really appreciate you coming on the program. We thank you so much for the great work that you and the team at the TSP are doing, and we look forward to having you back again very soon.
Thanks again. Thanks for having me.
Thanks, Kim. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score, a credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Tuesday, I sat down with the Federal Reserve Bank of New York's Andrew Howat to learn how small business owners fared during the pandemic. Let's take a look.
You know, I think it's fair to say that like lots of other businesses and lots of other households, small business owners have been hit extremely hard by the pandemic. You know, it hasn't been even across the board. There have been some variations, and I hope we get a chance to talk about those. But the sort of overall reductions in economic activity, especially at the very beginning of the pandemic, at the outset, about a year ago now, especially the reductions in consumption and particular kinds of retail sales have really been especially difficult for small business owners, in large degree because they may have smaller financial cushions to fall back on than, say, a big business. So it can be an especial hardship for small businesses. And then, you know, we see some of that being reflected in their personal finances, the finances of the small business owners themselves. So, you know, I should say that we use data on the credit reports of a large sample of households in the U.S. It's anonymized, so we don't have any idea who the individuals are, but we can tell a few things about them. And one of the things that we can tell is whether or not they own a small business. We can see if they match up with a small business registry. And so when we look at that, we can see that small business owners were much more likely than we might have expected to take advantage of particular kinds of programs. And the one that we focused on in the work that you're referring to is mortgage forbearance. So at the outset of the pandemic, Congress passed a law, the CARES Act, which either required or strongly encouraged people who are lenders, mortgage lenders, and the agencies that sort of back those mortgages in the federal government to offer forbearances to households that have had some hardship because of the pandemic. And by forbearance, what I mean is the opportunity to sort of delay or reduce your mortgage payment for a time while the hardship is still going on. And of course, as we mentioned before, the pandemic was a very widespread hardship for many, many households. And millions of borrowers took up this offer of mortgage forbearance. It was especially borrowers who you might have guessed, people who were maybe a little bit hanging on by a thread before the pandemic, had a little bit more of a challenging financial situation prior to the pandemic. But we also found that a lot of small business owners took up mortgage forbearance. In fact, they took up mortgage forbearance in much higher numbers than we might have anticipated. Why do I say that? Well, these borrowers are actually not just barely hanging on. They're not, sort of previously delinquent on their mortgages. In fact, small business owners, compared to the general population, have higher credit scores. They live in wealthier neighborhoods. They're less likely to have delinquencies on their credit reports, and they're a little bit older. So for all these reasons, you might have expected to see that they would take up mortgage forbearance, this offer the ability to miss some payments at pretty low rates. In fact, if you look at relatively wealthy neighborhoods, people took up mortgage forbearance at pretty low rates in wealthy neighborhoods, but not small business owners. Small business owners actually took up mortgage forbearance at pretty high rates. It's mostly the sort of really high rates seem to be associated with industries that we kind of know were especially hard hit. This gives us some comfort, by the way, that we're finding the right things in the data. The industries that are especially hard hit. So, for example, restaurants or entertainment venues, travel kinds of venues. These we know were especially hard hit. I guess putting it a little more generally, and then now I'm relying on work from some of my colleagues, other than the team that wrote the report you're talking about. We know that businesses that depended on discretionary expenditures more than sort of necessity type expenditures were the ones that got the most hard hit. So we know that like grocery stores, manufacturers, companies that produce goods held up relatively well compared to service industries. Some of that's because, of course, everybody needs to eat regardless of the status of the pandemic, but also because people were able to get goods delivered to the house much more easily than services. And so goods producing industries held up a little bit better than service producing industries. Now that's true across the board, but it's also true to at least a large degree for small businesses in particular. So I mentioned these mortgage forbearances, and they're an important indicator that we see of the distress that small business owners were in, to some degree at least, and also the ability and the flexibility that they took advantage of to be able to fund their businesses. So we infer from the data on mortgage forbearances that small business owners were sort of taking advantage of their personal credit to help keep themselves afloat, maintain their cash flow during the pandemic. And we see a little bit of evidence of that from home equity lines of credit as well. So what we see there is that it's not so much that we see new lines of credit being opened during the pandemic by small business owners, but we do see them drawing down their home equity lines of credit. So as you probably know, home equity lines have a limit. There's an amount that you're allowed to borrow against your home. That's sort of a maximum. And people may borrow less than that or up to that maximum. What we saw during the pandemic was that small business owners who had available credit on their home equity lines actually drew that credit, especially in the early months, in the spring and summer of last year. Now, that may not sound surprising or unusual, and you might expect that we would see that in a lot of kinds of households, but actually we don't see that in a lot of kinds of households. In fact, the trend in these home equity lines across households in general for the last 10 years or more has been for the balances to be falling. So it's pretty unusual to see a group of borrowers increasing their HELOC balances at any point in time. And we think it's especially telling that we observed that during the early months of the pandemic. Now, I should note, and this is getting to the second part of your question, starting in about the fall of last year, we see pay down resuming among small business owners. Pay down continued among non-business owners throughout the pandemic. We see increase in balances and then a resumption of declines in balances among business owners starting in the fall. That continued until March, when we got our last piece of data, March of this year. What I want to say, though, is that these small business owners still haven't caught up to where they would have been had they been more like the general public. And that's the kind of indicator that we want to see as sort of some evidence of healing here. So going forward, we'd expect to see that they would continue to pay off like the rest of the population. A sudden spike upward in the borrowing on these home equity lines would make us start to wonder if the cash flow problems of last spring and summer are reappearing. And that would obviously be a warning sign for the sector going forward.
And on Friday, I sat down with Experian's Rod Griffin to discuss preventing cybersecurity fraud. Let's take a look.
Even before the pandemic, it was important to check that credit report and that credit score because it's foundational to your financial life. It's one of those key components. Understanding what your credit history says and what your credit scores are, especially if you're planning to apply for credit, gives you control over what happens when you walk in to apply for that loan, for example. It can also give you insight into whether or not you've been a victim of identity theft. And during the pandemic, we saw predators come out and try to take advantage of people. So getting that report, you might find things that show you're a victim of identity theft. Having that report and knowing where you are in terms of a score can help you prepare to make an application and know when you walk in that the bank's going to say, absolutely, we want you to be a customer. And we kind of call it, one of the things we've said is it's kind of like having credit swagger. You can walk in and know that you're going to be ready to make that application and get the credit you need when you need it. And even easier than that, if you see something you believe is inaccurate, we encourage people to dispute that information. And to do that, all you have to do is go to Experian.com/dispute and follow the instructions. If you have a current copy of your personal report, we'll pop that up on the screen. You just enter that report number. If you don't have a report already, we'll give you a free one. We'll ask for some information and give you a free one right there online. It's secure, it's encrypted. And with every entry, there's a button that says, I need to dispute this. And you click the button and we'll walk through what that is. Is it not yours? Is it an issue of fraud? Is it something you've never been late on? Whatever the issue might be, and you complete a shopping cart essentially. And when you're finished, hit submit, and we go back and complete that dispute process. If you have documentation you want to send, you can upload it right through the system, and we'll send all of the documentation you have as well. You can also write, or you can call and dispute. It's not as fast. And so when you dispute online, it's fast, it's secure, it's actually safer than writing when you think about sending a letter that says it's going to Experian and here's all of my identifying information so you can get the credit report. When people get involved, that's when fraud happens. And so what most people tell us is they actually prefer to dispute online because it's easier and faster and actually safer. Yeah, and I think data breaches being key. If, for example, you are notified of a breach and they offer a free monitoring service, take advantage of that service. It will let you know when something new is added to your report. Doesn't cost anything, doesn't hurt your creditworthiness. If you're concerned and you don't have that option, you can enroll for a free monitoring service from Experian, for example, and just go to Experian.com. We don't charge for that. If you want a premium service and different certain things, you can pay an additional fee. You don't have to, so you'll get a basic monitoring service at no cost. So great tool to use. It's important to be notified early. The reality, sadly, I don't know why I'm smiling because it's not something to smile about, but we're all already victims. Our identity's been stolen, and it doesn't always involve a credit report. I was a victim of identity theft from tax fraud. So there was a breach at the IRS apparently, and they got my wife and I's information. Wouldn't have shown anything on a credit report. So identity thieves are clever, but monitoring that report, checking it, goes back to that first piece of our conversation. Check that credit report regularly, know what's in it, because that's going to help protect you. If you are a victim, there are steps you should take. So first and foremost, add what we call an initial security alert to your credit report. It says, I may be a victim of identity theft. You can go to Experian.com/fraud and do that. We'll notify the other credit bureaus of that notice, of that alert. They'll add it as well. So it provides some protection. You can get another free copy of your report. Check it. If you find you are a victim, add what we call an extended victim alert. That lasts 7 years, and it says, I am a victim of identity theft. You can provide a telephone number or two, like a day and evening, work and home. And that tells lenders, I am a victim of identity theft. Before granting credit, my name, call me. You'll need to file a police report first or a valid identity theft report. So that too is easy to do. I can tell you from experience. I went to my little police department in Texas and said, I think I'm a victim of fraud. And the officer immediately said, let me get the form. So even small towns know about it. And those two things generally are enough to protect a consumer if they believe they're a victim. They have to be responded to under federal law. They can't be ignored. But if you have ongoing fraud, or you are elderly and aren't using credit, or you have an elderly parent, you might consider freezing your credit file. And that's really simple to do as well. Go to Experian.com/freeze, and we'll issue you a PIN number. And anytime you want to access that report, if you're applying for credit, you'll need to lift the freeze first. I always stress, though, that freezing your credit file will not prevent identity theft. I hear that said often, and it's simply not true. It doesn't stop a data breach. It doesn't stop one from stealing documents from your trash. But if someone uses your identity to try to apply for new credit, it would not be able to be accessed, and it would stop in that fairly narrow circumstance. So it's a tool in the toolbox. It's just important to understand what the limitations are with a freeze and what it does and doesn't do. It's not right for everybody, but it is right for some, depending on where you are in life and what's happening.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.